From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the debate on the timing of a Fed rate cut rages on, while the data shows some strains in the economy, and we'll discuss how all of this might play out in the credit world. But we begin with the big issue, the data driving the Fed's decision.
The market this week wants better data. It wants to be assured that the economy really is strong.
The economy is moderating, but very slowly.
We're getting that modest slowing in the economy.
That'll be music to the Fed's ears.
In general, looking at this all very holistically, it's really going the way that the Fed would like it.
What Fed speakers need to do is to double down on their commitment to inflation stability and targeting inflation.
I think it's less actually what the Fed speakers themselves say. I think it actually will come down to the data.
I think the market recognizes what the Fed is trying to do. I think the market recognizes that the Fed is going to be data dependent.
Retail sales certainly supports the consumption side of the economy being weaker than what we've seen.
Downward revisions a month later that show a different picture when it comes to retail sales.
The market more concerned that maybe the Fed is more backward looking and not interpreting, not fully appreciating some of the recent slowing of some of the data.
Backward looking can be very dangerous in an environment where you have a lot of noise in the data.
There are a lot of questions out there about how the current level of interest rates is starting to impact the economy moving forward. And let's take a look at existing home sales data to begin with here, because the red line here is the month-over-month decline that you've seen recently in existing home sales. Now, they've fallen for the third straight month in May, particularly as prices hit yet another record, yet mortgage rates have fallen to the lowest rates since early April, declining for the third consecutive week, which can show you exactly what it means for investors to start taking their foot off the pedal here in terms of how high interest rates are and that ripple effect through the economy, particularly the mortgage market. Now let's take a look at the consumer, credit cards here in particular. According to Bloomberg Intelligence, delinquency rates could be reaching a peak. And this is across a couple of major issuers, Amex, Capital One, Discovery, Synchrony. And of course, these are where you typically see lower FICO scores here. You did see delinquencies start to come down by April. And though they've started to fall, there's a question as you see the next couple of weeks as the banks start to report earnings, just how much they will continue to fall as interest rates may indeed remain a little higher than expected this year. Now, there's a question of when that first rate cut will be. Lazard CEO Peter Orszag spoke with Bloomberg earlier this week about the Fed's path ahead.
I don't think it matters how many cuts happen this year. I think what matters is that first rate cut is indeed a light switch, because what that signals is the Fed believes that it has won the war on inflation, and so it's all downhill from there in terms of rates.
And joining us now is Allspring's George Bory and JPMorgan's Oksana Aronov. And you heard it there from Peter Orszag, this idea that it doesn't necessarily matter when that first rate cut will be. Do you agree with that, Oksana?
Well, I think that the first rate cut, to the extent that it will be, let's say, a 25 basis point rate cut, that the Fed has kind of backed itself into a corner where they kind of have to deliver it at some point because they've been talking about it for so long. It really doesn't matter, because we're in a world where the yield curve in the U.S. is so deeply inverted. What is that going to do when the 10-year is already in the low fours? Furthermore, I think you have to study history. And when you do that, you see that in the late 90s, for example, in the second half of the 90s, the Fed did execute a couple of cuts, and then they kind of held off. And you had elevated rates between 4.5% and 6% for a number of years. So I don't think the Fed cutting for the first time really is a long-term signal of anything. They are going to have to be data dependent. They tried not to be at the end of last year, didn't work out so well, and I think they're going to tread carefully here.
George, relative to market consensus, where do you think that first cut will be, and how many do you think we can reasonably achieve this year?
Yeah, no, as Oksana mentioned, the Fed really has painted itself into a box by trying to preempt its move at the end of last year, and now they are acutely data dependent, which means we need several months of data to validate both a downtrend in inflation and then some degree of moderation. So Our view is that they will have that level of data. It will come at somewhat of an awkward time, given the upcoming election, the upcoming presidential election. So that may influence timing, but we think by the end of the year, they will have sort of air cover, if you will, to cut rates at least once. The question of whether or not this is a cycle shift, in that they are actually going to be moving rates down systematically over an extended period of time. Again, as my colleague just mentioned, it really will depend on where the economy sits. If it's purely in reaction to moderating inflation, then a few rate cuts and wait that might occur. But if it's really in response to both moderating inflation and weaker data that's showing a downtrend in activity, then we can expect a rate cutting cycle. That is more, we're more in the latter camp than in the former. But we, like the Fed, as they made clear last week, the crystal ball is a little cloudy at the moment. And so we do have to wait to see what kind of data ultimately emerges over the next couple of months. But for clarity, we do expect the Fed to cut rates at the very end of this year, and then we'll see if that's an actual, kind of significant, if we're going to see many more.
George is definitely speaking to something many investors are struggling with right now. It's that mixed economic data you're seeing out there. And if you had to cut through the noise, Oksana, how do you really start to piece together how much room there really is for the Fed to cut, given where inflation is and given the weakening you're starting to see in the economy?
Well, I would contest that you're really seeing a tremendous amount of weakening in the economy, right? What is the Fed cutting cycle really telling us? And when we look at past Fed cutting cycles, what did we see? We saw higher unemployment rates. We saw significantly lower inflation. We would see housing issues. We would see issues with credit card delinquencies, which are starting to actually trend down. And by the way, never impacted the top 50% of income spenders. And that's really where the services and all other kinds of consumption is being driven by. And we saw services expanded this morning, again, I think the largest number in 2 years. So I would contest that we're seeing anything really breaking. And a Fed cutting cycle really is meant to address kind of meaningful breakages. And I think outside of something breaking here, I don't think there is any impetus for the Fed to do anything. And I think investors should really tread carefully around what is priced in. Right, so when they're looking at the 10-year at 4.2 or wherever it is today, really still priced for a 2% inflation world, is that really the world we live in? Right? What is priced in? When they're looking at credit spreads that are razor thin, you guys wrote this morning about high yield investors buying investment grade credit debt because the spreads are so minimal between the two. Junk bonds are sitting within 1% of 3-month T-bill yields. So what is priced in when you're buying these junk bonds, right? Why are you taking on that risk? And is it really going to reward you in a world where rates may actually move up if there is a continuation of strong growth, or if there is that kind of falling off a cliff and the Fed has to cut? Credit is equally vulnerable to both of those scenarios here. So I think that's really the important question, is what is priced in?
Hold that thought on the prospect of rates actually going up from here. You brought up this interesting point here about the inverted yield curve. The 210 curve is actually more inverted today than it was to start the year. George, what is that telling you?
Well, I think it's telling you that, as we mentioned, that there's signs of a slowdown is starting to emerge, and that the Fed is kind of is boxed in by sticky inflation. So they just have not had the air cover to be able to kind of follow through on the expectations of rate cuts. And the higher for longer mantra is starting to affect the real economy. You are seeing signs of it. It's not broad based. It's not extensive across the entire economy, but the most interest rate sensitive parts of the economy are starting to show signs of strain. The relatively high real cost of debt capital for borrowers, both on the public side, the private side, individuals, corporations, is starting to kind of change activity. And we think that the bond market in particular, is starting to get anxious or a little bit concerned about those growth expectations going forward, particularly as we get towards the end of the year and we get through our own election cycle.
Going back to that higher for longer narrative here, what would cause interest rates to move higher from here, Oksana?
So if you look at where unemployment is, where, again, housing is, right, where a lot of these sort of standard economic indicators are, where the stock market is, because we know that the Fed is watching it, even though it's not really part of their mandate. None of these things are really making for a start of a cutting cycle. If anything, perhaps the conditions for hike are in place. And I'm not saying the Fed is going to hike. I think the bar for hiking is quite high. But certainly, I think kind of basing a strategy in a bond portfolio, for one, on aggressively lower rates from here, again, outside of something breaking dramatically, is really not going to be successful. And the curve has been inverted for how many years now? Right, so I think it's really hard to talk about the forecasting sort of capabilities of a curve when you have $7 trillion of bonds still on the Fed's balance sheet, right? We only had, what, 2 to 3 on the back of the financial crisis, and now we have several times that. And imagine what would happen if they did decide to actually taper meaningfully. So I think the predictive functionality or the predictive function of the curve is very much in question here.
Oksana, sticking with us, that is Oksana Aronov and George Bory of Allspring. Now, to bring you some breaking news also that has been crossing the wire in the last couple of minutes, 4 of the biggest banks on Wall Street must improve their blueprints for a hypothetical wind down after the top U.S. regulators found weaknesses in their plans. The FDIC and the Fed reviewed the most recent resolution plans, also called living wills, which were mandated following the 2008 financial crisis. The regulators didn't identify specific weaknesses in the plans. The finding of a shortcoming doesn't result in bank penalties necessarily. They need to come up with new plans by July of 2025. Of course, this is JPMorgan, Bank of America, Goldman Sachs, and Citigroup, all found with shortcomings by regulators just days ahead from a Federal Reserve stress test. We'll bring you more later in the hour, but for now, stick with us. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block. Issuance all around saw strong demand this week. We'll start with Treasuries, focusing on the 20-year reopening sale, which saw the primary dealer award at the lowest on record since the tenor was reintroduced in 2020. The bid-to-cover ratio topped the average. And in corporate credit, Home Depot sold $10 billion. The deal saw as many as $47 billion in orders for the 9-part deal. It highlighted a week that saw $31 billion of debt sold, topping projections. And in high yield, Hertz works to bolster its balance sheet with a $1 billion capital raise. As part of the offering, it priced $750 million of first lien secured notes at par to yield 12.625%. And when it comes to credit, KKR's Chris Sheldon spoke to us earlier in the week discussing the potential for a wave of defaults.
We do envision increased defaults, increased downgrades. However, it's not sort of Armageddon in terms of a big spike of defaults. Not seeing like dramatic forced selling. I would say that when things are going into a default or things are really in dire, you see some more forced selling. But right now, it's not, Armageddon forced selling right now.
Joining us now is Ken Monaghan, Managing Director and Co-Director of High Yield at Amundi Asset Management. And still with us, Oksana Aronov from JPMorgan Asset Management. And you hear KKR, propensity here to lean into triple Cs, but then you have the spread problem. And so the question is, do you buy at spreads you're seeing right now, Ken?
Spreads are clearly tight. And it's hard to go out and say buy the entire market at the moment. I think you need to be very selective. Chris is an old friend. I've known him for a long, long time. And I agree with him that there is credit risk in the marketplace. I don't, however, happen to see the likelihood of a major increase in defaults in the next 9 to 12 months.
Now, it's interesting, Oksana, you made this point earlier about how you're not really getting much bang for your buck over treasuries. So why go into credit risk at this point in time?
That's my question. Why go into credit risk at this point in time? Double Bs, many double Bs, which is the highest kind of quality of junk, if you will, have a 6 handle on the yield, and you can earn almost as much in the 3-month T-bill. So why would you go into junk? But I think even perhaps more importantly, we typically, investors, associate growth with strength in credit. And our base case is that the economy will continue to do fine, will continue to do okay. These rates obviously are not tremendously restrictive. However, if we do continue to see growth, that means a higher for longer environment, which will make it more difficult to refinance. You know, that 12.6% rate that Hertz is refinancing at, that wasn't the case 4 or 5 years ago or even 3 years ago, right? That's going to continue to bite. Furthermore, if the strength actually somehow accelerates and you have higher rates, that is going to take a bite out of credit. And we've seen on dates when rates move up significantly, or even looking back at 2022 when rates caused all those losses, they caused them across the board. Because when spreads are razor thin, you just don't have the cushion there.
Now, how do you think about this in terms of potential interest rate cuts, Ken? If you see one this year, what does it mean for the money that might flow into different parts of the credit market?
I think, as Oksana has pointed out earlier, one of the issues that you look at and you say to yourself, if I get one rate cut, where am I getting value at the moment? I think if we look at the 10-year Treasury, I think it's pretty much already priced that in. So that's why when we're looking at fixed income markets right now, we're thinking to ourselves, there are kind of 3 key watchwords. You know, one is to stay active, because there's very little differentiation in the market at the moment. 2 is to stay very selective, which I commented on regarding high yield. And then I would say the third thing is to stay at the shorter end of the curve, because I think there is more value at the shorter end of the curve. And going out long isn't necessarily going to get you a big pop when rates start coming down, when the Fed eventually moves.
Yeah, how do you feel about the idea of taking on credit risk versus duration risk at this time?
Sort of like trying to choose between 2 foes, which is the better foe. So look, there are times, you know, when we see, for example, the 2-year part of the curve hit 5%. That's a great kind of entry point, and we like that, even though we don't really like taking on duration here for all the reasons I described. I think our 10-year is still not really priced for the R-star, if you will, that we are experiencing as an economy. And I think the Fed will reevaluate their 2% target, which is an arbitrary number to begin with. But having said that, I think you have to really kind of change your lens, perhaps. So when we think about investing, we aim to generate positive returns irrespective of whether the environment is benevolent for bonds or not, meaning whether rates are falling or not. That's a very different prism than trying to lose less money than the index, right? When the index goes down, the index such as the Barclays aggregate or the high yield index, whatever it may be. So my answer to your question comes from that point of view, which is don't lose money first, and then what's the best return I can deliver? And with looking at the market through that prism, where has there value? Where has there been value? It's been at the high-end floating rate on the market, high-quality floating rate. So that very short end of the curve, investment-grade corporate floaters have been great for a while. They're starting to get a little bit richer now, but you could earn, 6, even above 6% just a short time ago, and people didn't really like the floating rate nature because everyone expected rates to go lower, and they're not. So there are definitely things to do. Where has there been value? It's been very inexpensive to hedge credit risk. So to the extent that we believe credit risk will be repriced because defaults are going up, because some of these lower quality operators will struggle, it's very inexpensive to hedge yourself against that credit risk, and we've been taking advantage of that. So there are definitely things to do, but you don't need to be a hero now. And I kind of take exception with this consensus view right now that everything is great in bond land, extend duration, go buy credit, everything is great.
Everything has seemingly been great in bond land, and even if you don't see a big wave of defaults, let's scenario plan one more time here. We went through the 1 rate cut scenario, Ken. What if you see no rate cuts or even a hike in the next 12 months?
Well, I'm not sure a hike is in the cards. It's clearly a possibility, but I think the Fed's got a very itchy trigger finger to move the other direction. But if there were no hikes at all, I think the point is valid here that probably says something about the strength of the economy. Now, in theory, Oksana's point is correct, which is that means that credit spread should be doing all right and actually potentially tightening. On the other hand, it's hard to see spreads tightening a lot from where we already are. High yield spreads and investment grade corporate bond spreads are pretty close to their all-time tights, or at least the tights we have seen since the Great Recession. So that implies that there's not a lot of value there at the moment, which gets back to the point about needing to be very selective in this environment.
Ken, in this environment, favorite trade?
Favorite trade. There are no sectors we would point to at the moment where we'd say, everything is sweet, okay? So you need to be, again, selective. So we like the airline sector in general, but it's not exactly cheap. But if I'm looking at emerging market airlines, in particular Latin America, there's great value there. We happen to like the casino industry from a fundamental perspective. U.S. casinos tend to be trading at a tight level. We happen to like some of the ones that are in Macau right now. I mean, those would be two good examples of places where we see a bit more value, and yet we see some good credit protection at the same time.
Favorite trade, Oksana?
That is such a stock-oriented question, Sonali. Come on.
There's got to be something that you like
so I think
without being a hero.
Yes, again, so looking at the market through that prism of, as bond investors, right, it's do no harm first. It's sort of preserve capital first, and then what's the best return I can deliver. I do think there's going to be a significant dislocation. Credit, by the way, does not need to occur against the backdrop of a recession. You just have had so many companies that made it through 2020, for example, that probably shouldn't have and probably won't in their next refinancing cycle. So I think it does make sense to have a lot of optionality in the portfolio by staying shorter duration, ultra short, at the very front end of the curve, clipping that nearly 6% coupon, and then helicoptering out into high-quality floating rate, investment-grade floaters, buying that insurance on credit exposure, trading the curve, right? Where has there been volatility? It's been in macro, and we love volatility, and so trading the curve is another area that we've been active at. So there are many things to do, but I think the bigger returns are out there.
Ken Monaghan and Oksana Aronov, we thank you so much. Of course, complicated credit pickers environment. Now, still ahead, the final spread, big week ahead. Investors are awaiting the Fed's preferred inflation gauge and a whole bunch of Fed speak next week. This is Real Yield on Bloomberg. I'm Sonali Basak. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up as a week bookended by Fed speak. Of course, you have Mary Daly and Barkin speaking on Monday and Friday. And of course, new home sales, a 2-year auction, GDP and jobless claims throughout the week. All through Thursday and Friday, you have PCE data. Thursday night, of course, that U.S. presidential debate. And of course, starting Tuesday, that Bloomberg Invest conference. A lot of talk about that bond market. For my final thought, looking at the estimates of the PCE data coming in next week, the estimate for the deflator month over month is flat, up from a 0.3% rise in the prior reading. Of course, it's going to be a busy week ahead. We have a lot of inflation data and a lot of economic data, but for us, that does it for us here, same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.